You're about to join Jerry Parker, Moritz Siebert, and Niels Kostrup-Larsen on their raw and honest journey into the world of systematic investing and learn about the most dependable and consistent yet often overlooked investment strategy. Welcome to the Systematic Investor podcast series.
Welcome back to another edition of the Systematic Investor Series with Jerry Parker, Moritz Siebert, and I, Niels Kostrup-Larsen, where we share our knowledge and sometimes painful experiences of what it's like to be a rules-based investor, and where we end with some Q&A based on your questions, as we want this to be a listener-driven show. Let me start, as usual, by saying good morning to you, Jerry, and good afternoon to you, Moritz. How are you guys doing?
Great. Good morning and good afternoon.
Yes. How are you doing, Niels?
Doing very well, sitting in a hotel room in London this week. So if the sound quality is a little bit unusual, that's probably why. But before I dive into my usual market rant, I want to take just a couple of minutes to give a few shout outs to some of you who have taken time out to leave a rating and review on iTunes. And the first one I love is just this one from Nuberson, who's in the US, and he writes, "Give it a listen. No writers, no marketeers, nothing for sale, nothing but lifelong practitioners discussion, markets and managing risk. It's the one I can't miss podcast in my library, and I'm not even a trend follower." I thought that was great from someone who's not even doing trend following. Then there's another one which I thought was really kind, also from Amateur Trend Follower in the Netherlands. He writes, or she, could be she, "These people have been in the business for so many years and have an enormous amount of wisdom to share. You won't get this from reading a book or article, and they manage to find very interesting guests to join them from time to time as well. I listen to everything they produce." That's very kind. Thank you so much. And the final one is from Amit, and he has a very short one. He writes, "The only podcast I love." So I thought I just wanted to give a quick shout out to the three of you. Of course, there are many more reviews, and we appreciate every single one of them. And you should know that we read all of them. And of course, we would encourage all of you who may not have yet left a rating and review in iTunes to please do so. They mean a lot to us, and they mean a lot to the success of the podcast. So with that in mind, back to the markets. Let me ask you, Jerry and Moritz, just a quick question that came up this week. And the question is, would you lend your money for 98 years at 1.2%?
No.
What about you, Jerry?
No, not for 90. No.
Okay.
Couldn't do that.
Well,
or how about lending it for and getting less money back?
Exactly.
That sounds good.
And
Great idea.
I think you've caught on to it, because someone actually just did that. I mean, at 1.2% for 98 years, the Austrian state just reopened a bond that expires about 100 years from now, and it was well oversubscribed, even at this 1% rate. And almost I'm tempted to say, but wait, there's more, like they say in these infomercials, because also I picked up this week that the number of euro-denominated junk bonds trading now with a negative yield, has gone up to 14, something that usually was only associated with ultra-safe sovereign bonds. Now you have junk bonds trading with negative yields, which, I mean, just to be clear, this means that you have companies with bad creditworthiness getting investors to lend them money and getting these investors to pay for it. I mean, incredible. And of course, these forms part, or maybe they're even in addition to, the now $12.8 trillion worth of bonds worldwide that now has a negative yield. So to bring it back to our world, a week of correction, I think, for the trend followers. Yields rising, energy prices rising. So, current long bond positions and short energy positions might have been in for a little bit of an uphill struggle this week. But of course, it didn't stop the S&P from closing above 3,000 for the first time ever on Friday. Although on one of the lowest volume days so far this year. So with all that in mind, Moritz, how was your week?
Tough week. Lost about 3%, mainly because of the bonds. The bonds, like you said, Niels, the yields started rising. We all have firm long bond positions since many months, so that has lost us money. Actually made a bit from the energies, but give or take, it hasn't really moved the needle too much. Equities flat, lost a bit in the currencies. Bitcoin down, so not that much that was positive this past week. 3% down, and like you said, I mean those bonds are and the yields are amazing. I think what I picked up is that Germany issued a zero coupon bond at so that's a bond paying no coupon, and the issue price was 102 or something like that, right? So you're paying for the privilege to give money to the state, and in return you get back less, which, like you say, Niels, it's incredible that this exists, but the thing was oversubscribed. Speechless.
Yes, absolutely. It is an interesting world we live in, and you would think that certainly that encourages investors to look a little bit outside the usual places for good investment ideas. And perhaps maybe trend following would be one of those. Same sentiment on my side for this week. Certainly a down week, probably in the same range as you. Biggest losers were things like Japanese bonds, but clearly Australian bonds, European bonds didn't fare too well either. Energy was tough on our side. General short bias in those markets, so that didn't help. Some of the grains didn't do so well either. The hogs didn't do well either. And currencies were struggling for us with the dollar weakening a bit. On the bright side, we had cotton. Cotton did really well for us. Coffee, cocoa, so bit of a soft week on the upside. Gold did okay, and the U.S. equities, with the U.S. making new highs, and obviously I would imagine most trend followers being on the long side of those markets. That's really how our week turned out. What about you, Jerry? Anything exciting in your portfolio this week?
Always excitement, and that's exactly how I look at it as well. I was really excited this week about corn and gold, two rocket ships that took off a few months ago, and then crashed a little, now they're getting almost back to their old highs. So it's good to see that this is what we expect, or what I need to see, hopefully, when we implement a long-term strategy, that these vicious sell-offs don't last. They don't always go down. They can come back and the trend can resume. So that was nice to see those two markets. And emissions, I'll just try to choose some you have already talked about. Obviously, currencies were not that great. I sidestepped the profits in those bonds and the losses this week. So a lot of it, I'm really underpositioned in the negative yield area, which I think is a sort of a mistake, but that's the way it went for me. And I did have a couple of tweets, 3 tweets I wanted to mention about these negative yields. One was, as you mentioned, negative yields on European junk. Now I've seen everything. I quoted someone from a Bloomberg article. And another one was, I thought I'd never see the day, but Greek 10-year yields are about to drop below U.S. 10-year yields. So on both of those, my comment, I retweeted and commented bubble. So I'm really proud of that bubble. And hopefully, not for you guys, but I hope it keeps going forever. But if it does turn around, I'll probably use this as one of my pinned tweets that I kind of called this bubble. But it's also wishful thinking, since I sort of missed the trend as well on most of these European bonds. But and then someone tweeted the definitions of a bubble, which I wasn't that interested in, but my comment was probably helps for a bubble that no one's really talking about it. So I do think people talk about negative yields and they talk about the stock market, but I don't think anyone sees this negative yield thing as quite like a bubble, which I'm pretty sure that it is. And it'll be, in hindsight, I'm predicting that it'll be so obvious that there was no way this was sustainable.
I think the challenge with this is that it's just dragging on for a very long time. I mean, we've had negative yields now in some countries for quite a while, and with the sort of lack of enthusiasm in many of the underlying economies, and this maybe change of mindset, I feel, from authorities where you're not allowed to have a recession anymore, so they'll do anything to avoid that. Maybe we're all getting a little bit tired of it, even though I don't disagree with what you said. I mean, it feels like a bubble. But yeah, it's hard to change these mega trends. And as people have said for many years, you shouldn't fight the Fed, or the ECB, or the BOJ for that matter. You're in bubble land, Moritz, Germany, negative yields.
Yeah, firmly in bubble land.
What are the Germans doing with their money? They're not putting.
I don't know. They're buying real estate, I think. At least, property prices are on the rise here since the past 10 years. So everybody's saying that, there's no inflation, and maybe headline inflation is low or zero, right? But certainly there is a huge asset price inflation. So we don't have consumer inflation in the sense that, the yogurt in the supermarket becomes more expensive, but financial assets certainly become more expensive. Stock market, the bonds, especially property. And so it's kind of like creating that, or people say that's creating the massive inequalities that we have in our society, probably not only in Germany, but throughout Europe. Maybe the same can be said for the US. And so it is distorted. And this central bank policy of negative yields is something, it's hard to understand, how that can be sustainable for the long run. And but as all three of us know, we'll just hang in there and trade the trends. And right now it's the time to own bonds, whether you like it or not. That's not the question. It's just time to own the bonds.
Yeah, I guess. And also, I guess with the new ECB head, Christine Lagarde, coming in a few months, I mean, she has been quoted, as I think I mentioned last week, for saying something along the lines that negative yields is good for the global economy. So
yeah, it's a strange quote, I know. So maybe that trend isn't going to stop anytime soon, right? With her taking the controls at the ECB, maybe those bonds will go even higher. Who knows? We'll just follow the trend. But one thing, probably with all that inequality decision, if ever there were again, or well, not if, but at a certain point in time, there will be a bear market. We just don't know when that's going to be, right? But probably that's going to close the inequality gap quite a bit if we had a 50% drawdown in the stocks, because people owning stocks, that's normally the people that have money. So that will close some of that gap. And well, we'll see how it pans out.
Absolutely. Jerry, what else happened or what got some love and attention in the social media space this week?
Lots of stuff I was interested in, but probably not too many other people were that interested. But I'm undaunted, and if I like it, I'm going to talk about it today. But a lot of onesies and twosies on the like side, but who cares, right? Some of this stuff was, I thought, pretty darn interesting. Selfishly, I'll start with something I think the three of us are interested, like to hear. Yeah, this is a story that I love to hear. And whenever you read about, I don't know if you guys see these type of articles that Americans or whoever are, it's two separate countries, and we only read what we want to read. It reinforces everything we believe. I mean, I'm the king of that. I only read what reinforces what I believe. So here goes. This is an article from the Financial Times that talks about the reemergence of small managers. Small investment managers are going to take over now. And a lot of tweets here, but I'll try to keep it short. The quote is, "The moment you step away from indexing, the advantages of scale disappear. We're beginning to understand that asset gathering too often viewed as the yardstick for success, is at best only coincidental to good performance. So the article continues to go on that this age of asset gatherers has peaked. We're entering the age of the boutique where it began, and size will matter less than insight. Music to our ears, right? Although Dunn is pretty large, but I think it just reinforced my understanding that stick with your little small niche here and what you do well and focus, and they'll come and get you and find you. And that has absolutely happened to me before. Large institutions have, over the years, came and found me and said, I want to invest with you. It's my job and it's in my best interest to go ahead and find managers. And I'm putting together a portfolio now of CTAs or hedge funds. And so hopefully this is it's going to happen.
What do you come across? I mean, you're obviously working for a mega shop, Moritz. I mean, do you come across, this is certainly a point that I come across quite a lot in my day-to-day work, the competition within the trend space. I see a lot of these things happening.
So we've internalized the strategy essentially. I think it's a good sign that there is more boutiques around. I like that fact. Obviously, there are all those super large players, asset gatherers, and so forth. I'm not that interested in those. From the market observations that I make and the funds that I look at over the last, I must really say, 1.5 to 2 years, I found what I think are some really, really interesting jewels in the, say, 100 to 300, 400 million AUM space, producing spectacular returns. Obviously, with capacity constrained strategies, right? So it's always a give and take between your investment needs and the return potential that the investment will offer. The firm that I work for has a immensely large balance sheet. Any investment, within, say, the 100 or 200 million range isn't really going to move the needle all that much, right? So here, the questions, they become different. It's more you have to deploy more capital, and maybe those smaller boutique managers aren't that effective within your portfolio and you need to focus on other things. But if you do not have this massive, super large balance sheet, if you're, a smaller organization, an individual, I don't know, then, what I can say, looking at those funds out there, definitely it pays to look around and not only look at the well-known brand names, because there really are some great managers out there. They're still open for investment. Most of the guys I look at, they're 100% systematic or rules-based in the commodity space, or cross assets, trend or mean reversion, short-term type of trading strategies, vol-based, all of that stuff. Very, very nice. So I do like it.
Yeah, absolutely. Yeah. And yeah, it could be interesting. And maybe there is some, maybe there is a little bit of a resurgence of the sort of second tier in terms of size managers compared to the really big asset gatherers. Who knows? I thought that was a great start to the tweet session. Jerry, what else have you got lined up for us?
Well, I got a lot of good creative stuff this week from George and Woody. And one of the things I think George introduced me to is this quote: people like to take profits and don't like to take losses. They also hate to repurchase something at a price higher than they sold it. Human likes and dislikes will wreck any investment program. Now, that's like one of my favorite sentences, because I'm always kind of bringing up this idea that don't go too far. A lot of people like to say, find something that works for you. There's lots of things that work. I kind of doubt that. And then go ahead and find something that suits you. Well, I'm not so sure about that. I mean, to some degree, okay. But, one of the things is trading may not suit you. So if you don't like buying the highs, if you don't like getting back in and taking small losses and having most of your profits just determined by a very low percentage number of your trades and all the characteristics of trend following, then maybe it's just not for you. That I totally get. But I remember probably 1983 asking my mentor what are some of the biggest mistakes we're going to make. And before I even started trading, and he said, well, probably you're getting back in. You won't get back in. And I think that's one of the sort of problems with trend following is that we have to get back in. When you get out too quickly or your system is too short term, let's say, like mine used to be, I would say that that's the cost. And it's great to get out and not watch the market keep going lower, like gold, like Bitcoin, like corn, these violent moves. Oh, the market's not acting like I thought it was, another thing that I don't like. So usually these trends, when they start, they just keep going. No, there's no such thing as usually, and you don't know what's going to happen. And so I think hanging on to that trade and not getting bounced out. But if you do, you got to get back in. And so that's another one of the reasons I trade a little longer term, is that it seems to work better. You don't have to keep getting back in all the time.
One of the markets, just adding on that, which I observed and actually run a quick test on this past week, are the emissions. And I think, Jerry, you're trading them as well. They've had this about a year and a half ago. They've had that spectacular trend, just very smooth. And it wouldn't really matter whether you traded that with a long-term or a short-term system. That would have just worked, right? But then in the past, say, 6 to 9 months, I think, the trend became a bit more choppy. There were some, range-bound sideways periods in there. And if I had a shorter-term system, I would have gotten kicked out of that position at least 3 times. And it's only because I have that longer-term approach that kept me in that position. Of course, it didn't make me a lot of, it essentially only created volatility in the past 6 to 9 months. But now, here you go. It's moved from 25 to 28, making new highs now. And it just feels great to still have that thing on.
That's right. I've looked at some of the charts yesterday. I think one of my longer term systems, it's not incredibly long term, but it is, right, I think in the right space, right spot. I think by some degree, I could look at that chart. I printed out a multi-year chart, and I think it's been long booms since 2009. And
that's a long time.
Yeah. And there's other trades out there too. The Turkey currency, back in the day, euro yen, I think had 5-10 years of a trend. But there was a year period in there in the booms, past few years, where it just didn't move. So, it's kind of a bummer. You're sitting there, you're waiting, you're wondering, do I need this exit strategy that exits after a certain number of days and hasn't made a new high? I don't know. So you sit there and you roll it. I mean, I guess there's some cost to holding it. There's some minimal cost to rolling it, and it's not moving, but then it makes new highs and then it keeps going. And then another thing that's really good too is that, and this sort of, the back test picks all of this up and says, another reason to trade long term is that when you first get these new breakouts, whether they're this year, a year ago, or 9 years ago, the ATR, the volatility, is really low. And so you throw in this massive position, and then if you have to get out and get back in, the chances are the vol will be higher. So you have to get back in with a smaller position. So there's many different reasons to prefer something longer term. And then, of course, the downside is when they start to crash and your trailing stop is a long ways away, you can't get back all that profit. Now, what are you going to do? You want to be long term, then you want to be shorter term.
I mean, I think you bring something very important up in this discussion, both of you in a sense, and that is, I sometimes refer to one of the secrets to the success of trend following is diversification, but I think another secret to the success when doing trend following is being able to just sit on your hands and do nothing. Like you said, I mean, being in a trend for all these years, I mean, if most people who don't have or who chooses not to follow rules with 100% discipline, they will be tempted along that ride to to trade, that in itself, could be a great weakness of an investment strategy, that you simply too trigger happy, getting in and out too often without making real progress. So yeah, very important.
Yeah, I looked at that chart, and I was like, well, what would I have wanted to do different? Okay, avoid that year period where the boons just chopped around. But other than that, and I think you guys talked last week, and maybe we'll get into some of the things you talked about after I couldn't continue as it relates to the questions that I think Sam had.
Oh, yeah, sure.
But I think that, being long-term is, there's many different reasons you want to do that, primarily because it kind of works, and the markets are more choppy these days.
Yeah, definitely. But before we get to Q&A, anything else you want to bring up from this week's tweets that you got engaged in?
Well, feel free to exercise your authority as the leader. So I could keep going, but Wayne is just one of my favorite guys, Twitter guys. He's so smart. He's so interesting, and he lets me kind of like take his tweets and comment on them, kind of in kind of a, I don't know, not a rude way, but kind of like not making fun, but kind of walking the line of Wayne is kind of, he's quiet, but he's not trend. So I want to bring him back to our side more on the trend stuff. And he always likes it, and he doesn't criticize me, and he doesn't criticize anyone. So I take the liberties to comment on some of the things he says. So one of them was brain fitting is more dangerous than curve fitting. That is talking ourselves into why the findings make sense, mistaking, justifying for reasoning, then acting with false confidence. That's Wayne. So my comment was, I have no data, I have no ideas. I have nothing that makes sense, no justifying, no reasoning, and no confidence, true or false, outside of my trend following systems, that is. So I think we need to bring our friends over to our side and continue to remind them that a lot of the things that they have to deal with, we don't deal with due to just following the price.
Yeah, no, absolutely. I did see that tweet, and it's great, and it's great that Wayne allow us to comment like that as well. So without taking any offense of our attempts to bring him to the right side of trading. Anything you picked up, Moritz, this week? Anything in particular?
Yes.
You saw? Yeah.
Yes, there's one, and Wayne is producing all these gems. There's one gem a day coming from him. So here's double quoting him, but this one I really liked. It's when mistakes happen, it's like buying at the money options on yourself. Over time, if you learn from it, you go further in the money, and if you don't, further out. To increase your chances of being deep in the money before expiration, of increasing your value, learn from your mistakes. And, of course, we all know that. We've said it before. It's important to learn from mistakes. It's important to make them. I think, they cannot be avoided. It's part of the thing, part of the journey, part of trading is making mistakes, but then learning from them and not just tossing them to the trash can and forgetting about them is extremely important. And, you can say it in a million different ways, but Wayne always has that fantastic skill of, saying it in a quantity type of language, this time using options. So I really enjoy that. He's one of the favorite guys on Twitter.
Absolutely. I'm sure many of our listeners are now familiar with Wayne's Twitter handle. What else, Jerry, on your side, before we jump into some of the week's questions?
Well, of course, I always like to have a tweet about the sample size and how important that is. This comes from a Bloomberg article. If it's less than 30 years, I wouldn't look at it for factors. Identifying a factor is like detecting the direction of a gentle breeze in the middle of a hurricane. You need a lot of observations to tell. So I love that idea that predicting and anything other than a really long back test with a systematic approach that produces lots of trades, legitimate sample size, is very important. There was another tweet, I haven't found it yet, but it was something along the lines of some fundamental or value metric that has predicted the last 8 recessions every single time. It's eight for 8.
The inversion of the 3 and 10 or something like that?
Could have been something like that, yeah. And then I just retweeted, a sample size of 8. And I think that this predicting and this looking at things like this, just, once you start going down that road, it's really hard to get away from it. I mean, we know people who can't get on the stock rally. They've been out of the market for many years. So, and yet they kind of maybe respect trend. They understand trend. They like it, but it's these valuations. And how do I get myself out of this bind? And as soon as I give up, as soon as I say, yes, it's the trend, that's when it's going to go down. And they know this. That's why they continue to hesitate and proselytize about value, which, doesn't work. There was another quote I just saw that was something like, to say that these value metrics and these ways of valuing the market and timing the market are not working, the fact is that they've never worked. And I think, whoa, that's really, really good. If you're not going to embrace trend following wholeheartedly, at least embrace the fact that you can't predict. And that's what this is. It's just predicting.
Sample size, you bring up something interesting. One of the newest videos on Real Vision is with a very interesting gentleman called Milton Berg. I don't know if any of you saw that one. It just came out. And Milton Berg focuses on turning points and has worked with some of the absolute best traders in the world, George Soros, for one, Stanley Druckenmiller, just to name a few. So clearly he has, a lot of credentials, a lot of success. And he was talking about how they calculate all sorts of, thousands of different indicators. But interestingly enough, he also said, even though we don't have much of a sample size with some of these indicators, we might still, and he almost reversed it back to say, well, even if it's only happened twice, doesn't mean it's not a great indicator. And so it was quite interesting. It was a little hard to follow, I would say, because on one hand he's saying, well, it still might work, so why not follow it? And I'm sure he wants many confirmations before putting on a trade, but it was slightly different sort of thought process that the three of us would go through, where we say, well, actually, we need a meaningful number of observations before we can kind of rely on it. But it's worth listening to. I thought.
I met Milton years ago. He's a smart guy.
Yeah.
I don't discourage that type of thinking. We don't want everyone, it still needs to be a small group who are going to put themselves through the misery that trend following can inflict. So I don't discourage that. And I think that's just normal human behavior. And I think it's very difficult for incredibly smart people, especially coming from other fields with their PhDs, to, plop down in a chair and say, oh, okay, breakouts, wonderful, I'm done, that's great. I can make a lot of money in breakouts. It's just inevitable. They can't stop themselves. And then one of our friends, Antonio, he gave me, I think he was giving me the impression that another idea that people gravitate towards is recent data is more important. So that's another thing that's probably runs afoul of how we do things. And I do think that that's possible, that recent data might be more relevant, I guess. But I don't think as a trend follower who understands all the ideas of trend following and the backtesting and the sample size can allow themselves to think that way.
I agree with the signal generation. That's probably not how we wouldn't put more or less weight on any part of the data. Although I do think that maybe in our risk management we could we could put more weight on, say, recent volatility compared to volatility 5 years ago.
Sure.
Things like that.
Yeah, right.
Yeah. Yeah. All right. Well, I mean, maybe there's some more tweets we want to talk about, but I definitely want to go back to a question that came up last week after we lost you, Jerry, but it was really a question for you. It was from Sam. So thanks very much again, Sam, for your support, participation. And Sam writes, in the past, Jerry has said soon after the Turtle program ended, he realized he needed to take his time frame from 20 to 40 days and lengthen it by 5 to 10x. What evidence or experience would lead to this realization? Obviously, becoming unprofitable might be one, but we tend to look at other metrics. Would it be an increase in trade volume relative to the past, shorter trade duration, lower win percentage, noise/volatility increase, etc.? The realization is very profound and critical, so understanding a bit more of the underlying factors would be helpful. While I use Jerry as an example, I think you can all contribute on this. I think Moritz and I talked about this, but we certainly didn't hear your views on Sam's question, Jerry. So you need to go back a few years and see if you can remember.
It's a couple of different ideas. Obviously, the backtesting, then the just living through the markets. That usually is going to prompt you to for some research ideas, some backtesting ideas, and ways to handle the recent, failures of the system. I would say, that you gave back too much profit, or you got in and out too much, got chopped around, whipsawed around. So obviously that was prompting me. And then I just all of a sudden started looking at weekly charts. I don't trade off of weekly charts, and I don't choose my systems based upon looking at charts, but I do come up with ideas based on charts. And these weekly charts were very eye-opening, because with a weekly chart, you can cram in 10 or 20 years worth of data on your computer screen. You can see these massive trends pop out. The boomed, 9 years, or many years, couple, 3 years. And so my whole time frame, what I thought was appropriate, started to change when I saw, wow, there's a lot of in and out here I've been doing, but this market has been in a trend for a long time if you look at it on a weekly basis. And then when we started doing the back testing to move towards that longer time frames, we found that the shorter time frames were deteriorating, but that the longer time frames were always better. I've said this many times, and no one's called me out on it. So, do some work, someone call me out on it. But that's my recollection, is that my research people said, yeah, these parameters that work good now, and the other ones that we've been using are getting worse every year, but these have always been just as good or better. Wow. It's not like we said, yes, the markets are getting choppy, and the systems we're trading now are too short term. Now we've got to be longer term. Not only was that a good solution, the drawdowns were larger, the Sharpe ratio was worse, et cetera, but we were back to making money. But it's always been a good to trade in the relatively longer term, 50-day moving average crossing the 200-day moving average time frame.
Yeah, I mean, I don't have any data from the 70s and the 80s on this particular question, but I do have data from 90 and onwards, so 28 years, and certainly using a trend-following methodology, very similar to what we do in our live trading. First of all, we see quite a lot of difference really from year to year. And I've mentioned this before. I mean, you can have a year where 40 days look back is the optimal, and the next year it's 240 days. I mean, that's not uncommon, but there is a bit more of a cluster in the longer term time frames, and I'm talking about the absolute best time frame. So if 40 days is a good time frame, it doesn't mean that you wouldn't have made money in 140 days or 240 days. It just means that 40 days was the absolute optimal that year. But But no, it rarely clusters in the shorter term time frame, and we actually do this on an ongoing basis. I mean, we allow the model to recalibrate itself, and we don't restrict it necessarily on the shorter term time frames, but it just never selects anything in that time frame. So I concur with what you say, Jerry. I think that's what the data still supports in terms of how trend following should be done, at least on a diversified portfolio. I don't know if you were trading just one sector, what it would look like. Probably different, but on a fully diversified portfolio, I think that's true. Have you done any work on this, Moritz? Or
Sure. I mean, like we said last week, looked at all those time frames, and then discovered that the trade statistics for the shorter term time frames are inferior to the longer terms. So that was a relatively easy decision to make, and especially because, like you said, Niels, there is a cluster of, say, effectiveness around the longer term timeframes. So you tend to trade around there, or at least I tend to trade around there. But I've also mentioned that I have not fully turned the other things off. I do like the diversification that I get from trading different speeds, trading different markets, long and short, all the time. Also, people may want to consider combining, daily bars and weekly bars. All of that can add diversification to your portfolio. So having a mix of things in there is important, and then just, following through with it. But it's tilted to the longer term side of things now.
And I think when you look at these longer term systems and you try to trade multiple entries, multiple exits, different parameters, that's what I try to do. Even though I'm in the medium to really long term, I have different 3 or 4 different entries, 4 or 5 different exits. When you get a trend going, they're going to be 90% correlated. And then when the trend reverses, if it's a material trend, if it's one of those big ones that we're waiting for, then there could be quite a bit of difference between the systems and how much money, what's the P&L of those particular trades. So one could be 100 ATRs, one could be 50 ATRs, although it's been 90-some% correlated for the past year because, you got in about the same time and you just held on to the position. So it's kind of a weird, one of the weird characteristics of trend following. You're like, why should I even bother? All of these systems are so correlated. Yes, but when the P&L gets realized, it could be vastly different. You get out at your shorter term system, the longer term stays in, and it keeps going up, and you have to get back in on the shorter. I mean, every combination can happen, and so it's really worth sticking with the long term, but trading multiple entries and exits.
Yep, absolutely. Now, Sam has another question that he sent in a little later, and of course, he is bringing up a frequent topic that we love to talk about. Sam, I know you know this. So Sam is I was going back through previous episodes, and in March, volatility targeting was brought up frequently. Sorry for bringing it up again. On multiple occasions, Moritz and Jared talk about the effects of vol targeting and even just adjusting the ongoing position based on volatility changes the following way. It leads to smaller profits, trading larger and larger average losses. Can you expand on this practice? Why is this true? What exactly is going on for this to be the case? Is it because the position is smaller than it would otherwise be for the huge winners, along with adding to positions that ultimately become losers more frequently than winners? I can conceptualize the smaller profits fairly easily, but the larger average losses is escaping me still. Right, guys. So does this ring a bell from our conversations back in March?
It rings a lot of bells, and from many, many conversations, I'm obsessed with this topic. So, yes. But go ahead, Moritz. I want to hear what you have to say first.
The volatility, the ongoing vol control system, to me, is an overlay to a trading system. It does not have to do anything with the original premise of finding and trading trends. So let's just recount that is a fact, right? Now, what you want to achieve with a vol control system or that overlay is a relatively constant realized volatility of your P&L stream. Whether or not that's desirable, different question, but that is the target, right? You decide on a certain level of target volatility, say that's 12%, and then positions are sized on an ongoing basis to match that 12% level. Now, it depends on the markets in your portfolio. Equities behave in a different in a different way than the bonds and FX. But as a general rule, if volatility gets lower and lower and lower, then regardless of the asset you trade, your position size will get larger and larger and larger, regardless of the trend, right? So you do have, let's break this down into a couple of things. There is a risk and a chance, but there is also risk that you're sizing up on positions, you're increasing risk because you're trading larger, and then the trend stops, right? Or there's a gap in the market and you're extremely exposed much larger than originally you would have been, right? So there's a risk there. Of course, if the trend just continues smoothly, you'll enjoy the larger position size. But as we know, every trend at a certain point in time will come to an end and you will have a larger position if and when that happens. Now, the opposite is true if volatility is getting higher. If volatility is getting higher, then you will reduce your position size. This may feel good initially because you're trading smaller and the market is volatile. But what does that volatility in that market really mean? A volatile period in a market does not necessarily mean that that market is going down.
Emissions.
Emissions, very good example. We've just had a period of higher volatility in the emissions market for the past 6 months. And it's been much less volatile prior to that. Now, you will now have a smaller position size in the emissions market because volatility has just been a bit higher. The trend has kind of like, taken a little bit of a break there, but now it's back in play. It's making new highs. So this is the type of scenario which really I don't want to have inside of my trend following trading system. Certain markets do go, or they all go, I think, through more volatile periods, even if the trend continues. Sometimes you will see that the trend is becoming really choppy and volatile at the end as it's making new highs, and still it's then going higher, right? And it's exactly those periods where, I don't want to be playing around with that position size. And this is my main point of critique around that system, around that vol control overlay, that it's not really an integral part of a trend following trading system, and I don't see why it should belong there. In fact, when we all look at trade statistics. I know Jerry does it in the same way that I do it. And when I have the vol control features switched on, I don't even know how to count those trades. The way I look at it is, I count my entries, I count my exits, I count the winners, I count the losers, I calculate the average win, the average loss, et cetera, right? But those vol control trades, they kind of like they're doing something strange to the portfolio. I don't know where to put them. And what I can say is that the risk that you are with those vol control trades trying to reduce, that risk does not disappear. That risk goes somewhere. And in my experience, and also looking at the statistics, it does show up in a larger average loss. So this is my observation of the thing. I do get larger average losses with a trend following trading system if it is vol controlled. I don't know where to put the trades. I don't have the desire to trade at a constant level of vol. I don't mind if it's, overshooting 2 or 3% to the upside or to the downside, every once in a while. Over the long run, it's, realizing a certain level of vol that I want it to realize. So I don't have to be laser pointed there. And yeah, so apologies for that being very, very long stretched, but I hope I've touched on the most important points here.
Yeah, A+. That was everything. I have a little bit of something to add, but all of that was perfect. There's nothing more important that you started and you ended with, and it's not a system trade. It's just that simple. They're not system trades. It's a portfolio overlay that can overwhelm your entry exit large sample size backtest. I don't know how you get around that. I've mentioned this for many, many years. I'm just waiting for someone to tell me and show me. But I understand, I think, what's happening here. And I'm a little, yes, maybe they do want this constant, more constant volatility, and it's easier for them and for the clients, especially clients who love this stuff. You just, a smart person can tell them they can do this, then they're all over it. But I think that it's probably more a choice of what are we going to do now that we have to trade so long term? We have to have a strategy that doesn't give back all of the profits. So we're great. We're great with the boon for 9 years or 10 years. But now it's really started to make a lot of money. It's started to get a little vertical going up here. And if it starts to crash, we're going to give back a year or two's worth of profit. So what are we going to do? This is the Achilles heel, and more than just a heel, of long-term trend following. So this vol targeting fits perfectly. It fits right in there. We'll be selling. We're calling it risk management and risk and money management and risk control, but it's really helping us because we'll sell some boons at the highs. And most of the time, when you get into these big trends, you're making lots of money. The volatility is going way up, and so we're taking money off the table at the highs, and this is just going to make the Sharpe ratio look so much better. And I'm not against having a mega profit in the fall. I had this. I tell these same stories all the time, but I had this dollar index trade 5 years ago, whatever, and the volatility had increased 10 times from when I bought it. That's fine. I mean, you've got this mega profit. You've been in it for a long time. You've made a ton of money. The volatility is crazy. You can't even sleep. Yeah, take half off, take a third off. It's just random. You could keep going and do that in emissions as well. I mean, who cares? It's not going to kill you. You'll probably get out even lower if you wait for the trend exit. But don't call it math. Don't call it part of the system. It's the opposite of that. So I think this is. But to answer the question, about the smaller winners, is that when Moritz and I, when we're going to make more money because on this emissions trade, because we never got out of any. So our average profit is going to be higher, and of course our drawdown is going to be much higher as well. So it's kind of like, okay, they're all saying okay, I'll grant you that the average winner is smaller because I'm trading smaller, and if I'm trading smaller to make the same return, I've got to trade larger. And I have to risk a little bit more. So if Jerry's risking 50 basis points, maybe I have to risk 60 or 70 in order to make the same amount of money, which is fine because taking my system and overlaying it with portfolio risk control and vol targeting, this is what we do. It makes it a more efficient system. So the math says you can leverage it up. Now we're back to it's not a system trade. There's no sample size around it. And you are leveraging it up. But it's a wobbly system. It's wobbly ideas. And so that is probably not as safe as just keeping that risk in open trade profit versus transferring it to larger losses.
So I have to be a little bit careful here, I think, because I'm the odd one out here. Like the little sheep coming into the lion's den, I think. But we take a different approach. We, but it's not. But I don't disagree on some of the key points. So, for many years, pretty much from 1974 all the way to 2013, we were using a fixed risk budget. So not volatility targeting. Volatility could change. But we were using a fixed budget for valued risk. And that means, of course, that sometimes you go through some highly volatile periods because you're not really, you're dialing to the same risk level every single day. But on the other hand, we knew internally that there are times when there are better environments for trend following. And there are times where there is, a bad environment for trend following. So to us, it didn't make sense to always have this, why would you run at full speed all the time when you have these different environments? So we came up with something that we call the adaptive risk profile. Now, this is not vol targeting. We don't target the same volatility day in, day out. In fact, we don't target volatility at all. But we now change our risk budget, and it can be adjusted essentially on a daily basis depending on the environment. So it's not, I think, what Jerry and Moritz is against, but it's a different way to managing the risk. First, I'll share the outcome of doing it this way. So according to our data, both live and what we were expecting from our research, we've been able to reduce the volatility of the product, of the strategy, by 25% without giving up any of the upside. So for us, that's a very important improvement because one of the things that doesn't allow investors to really benefit from trend following is that they can't stick with it if it's too volatile. Or the drawdowns gets too big. So for us to be able to deliver the same returns, but with a higher risk-adjusted profile, is something that we've wanted to do. So that's kind of the first part. The second part is, I understand completely what Moritz is saying is, I don't know what to do with the trades, right? And this is by no means a criticism to how Moritz or Jerry is how they do the trend following, but I don't necessarily think you need to look at these things on a trade by trade basis. We used to do that, but with these new things that we do now, we've taken a much more statistical approach to the whole portfolio. Portfolio construction, managing of the risk of the portfolio is an integral part of what we do. It's not just about entries and exits. It's the risk management, which we talk about as being important. Well, if it's that important, it should be part of what you consider your overall system, in my opinion. So I know this may be different in terms of view, and there's no wrong or right. Clearly, we all have long track records that suggest that these approaches work. But we've certainly found it useful in our case to look at these things slightly differently than maybe the way we did it earlier from a trend following perspective. So I think I'm going to leave it there without getting into too much trouble.
I think that's great. That's a very good, and I think most traders agree with you. So I would just make one comment, and that is that I prefer, which doesn't mean a lot, but I prefer to think that there isn't more than one way. There is one right way. And I prefer to think that you could have the right way rather than my brain cannot handle that. Oh, it doesn't matter how it. Well, it may in the long run kind of like not matter. I've said many times after going through these rants about this that I don't see any evidence in anybody's performance. My performance is not any better, and certainly the larger CTAs that do vol target, and so they're large, and so they don't have to defend themselves. Their AUM is all that the majority has spoken, and people favor this type of trading. But I don't know who is right or wrong, but there is one better way of doing it, and you absolutely could be right. There's no doubt about it. And I do think that, especially coming from my background, another thing that really stood out is this. I forgot how you worded it, but it was like you don't have to do the transaction by transaction, the buy and the sell. And that's the cornerstone or the foundation of everything I believe in. So way too old to switch.
Yeah, no, 2 comments on that, Jerry. First of all, I don't consider what we do as vol targeting. So the way you talk about vol targeting is people who always try and keep the portfolio at a certain level of volatility. And we disagree with that like you, we think that's completely nuts to do that. And so we're not trying to do that. I mean, our vol, will change, for sure. What we're trying to do is we're trying to integrate our overall risk budget, a little bit more than maybe just looking at it. Okay, I'm going to take 25 basis points risk on every single trade I get. So we're trying to say, well, let's just look at how much overall risk do we have, based on all these entries and exits we're getting. And sometimes if the environment is not conducive to trend following, we want to pair back on that. And when we see opportunities, not just from the signals, but also from maybe correlations, et cetera, we might want to take a little bit more risk on that. But to your final point, I think that I fully understand, and I kind of come from that school as well, that you really look at entries and exits and you analyze all your single trades, and the trade stats are very important. And I don't disagree with that at all. I think this is really the crux of the matter for how trend following has, where we come from. I think from our point of view, we're just trying to maybe also say, well, on top of all of this, you can't ignore the overall risk you're running from all of these signals. So you need to somehow, and I'm not saying we're doing it the right way or the best way, but somehow you need to take that into account as well. And not treat every single instance as an isolated instance. Maybe that's what we're trying to do.
Yeah, I agree with all of that. And the way that I handle that would be to, the massive amount of diversification I can get as much. I need a lot of diversification.
Yeah.
I need to set my max risk on day one. I'm setting my max risk and I'm done. That's my max risk, and I have to live with that.
Yeah.
And sometimes, because my max risk is based upon the risk when I put the trade on, the ATR now, as we've been talking, that ATR has changed a lot. It's gotten a lot larger. So why are you still paying attention to your original risk, your original max risk, when the volatility now is so much higher? Once again, if it gets out of control, cut back a little. And that's the way I would handle it. Just intellectually, I would say, I'm going to cut back a little here. I'm not going to waste my time with a back test. Hey, right now it's too volatile for me, for my clients. I'm guessing a little bit. And I just think, to me, putting in all of these rules would just be me kidding myself. I'm not against rules. It's just the back test. The future is not going to look like the past necessarily. Moritz, rescue us.
All right there. I don't think there's all too much to add. One thing that I want to mention is let's bear in mind, I mean, the vol control trades, I may be wrong there, right? Maybe you guys tell me that it's been around in the 80s, but in my experience, that thing has really started in 2007, 2008, when the first large number of vol control products came out. Prior to that, maybe volatility has been controlled in a different way, but certainly investment banks have issued loads of indices and products which have a daily vol control feature. So that's a 10, 11, maybe now 12-year-old product, which I think undoubtedly creates tremendous flows in the market as of the close or toward the settlement, all of that type of stuff, right? So just a word of caution there also. And this, by the way, has nothing to do with risk parity funds, which rebalance, I think, much more infrequently than daily. But the daily vol control type of thing that's going on the S&P or on other indices and multi-asset portfolios is creating flows. And it's a thing that's around for, like I say, 10 or 11 years. It allows banks to, produce products and price options on portfolios which otherwise they couldn't be pricing options on. So it has facilitated a new type of product category. And, for what it's worth, it just, to me, having my system not being or not taking part in those flows feels good. Those flows may trigger exits or entries, which maybe otherwise wouldn't have been there. That's a fact that we have to live with. Nothing I can do about it. But But putting myself into that, daily float trading, trying to hit the same prices as all those guys out there, I'm not keen. Yeah, that's the final point on that.
Great stuff. And Sam, I think you were absolutely spot on that this is a topic that we love to talk about. So don't bring it up for another couple of months before we. Okay.
But please then bring it up.
But then do bring it up again. See if we still.
Woody brought up another topic, which I won't mention, but we do have a couple of topics that get us going, and I fully embrace the differences of opinion, and I caution anyone to agree with me over YouTube when we differ, because I don't even really know I don't know the answer to these questions. They're difficult.
No, and I think just to be absolutely clear, when Moritz and Jerry says they're against vol targeting, so am I. It's just that we on our side, we do things differently to the way Moritz and Jerry does it. But vol targeting in itself, just indiscriminate vol targeting, we have not found that to be a good idea either. So anyways, Cathal has a question for us. Firstly, to yourself, Moritz and Jerry, many thanks for a fantastic podcast. For a retail investor to gain access to this level of knowledge delivered with such passion and calmness is astounding. I'm not sure about the calmness, but passion for sure. My question today may be more relevant for Jerry. Backtesting has many nuances and pitfalls, but I find the application and interpretation of the results more difficult when it comes to individual equities. After screening or filtering the equities which meet your criteria, I would like to ask how you then apply backtesting. Equities which meet your criteria today may not have met them last year and may not have even existed a few years ago. Even if a company dates back 10 years, its earnings growth, market cap, institutional ownership, etc., or whatever screening you use may have changed significantly, meaning you backtest is capturing periods in which your selection criteria are not met. In contrast with commodities, forex, fixed income, and even long-established ETFs, individual equity characteristics change continuously, negating the validity of longer-term backtesting results. How do you account for this in validating your strategies on individual equities? Many things, if you have time to include in your next podcast. Of course, absolutely. Thank you so much, Cathal. I look forward to hearing Mr. Parker.
I don't know if I understood all of that, but I think
it's how you select the universe of equities and then actually be able to go back in time and kind of ensure that those criteria you based on your selection today are still met back in time with individual equities.
Yeah. Well, it's a tough way to. It's a big discussion, but we trade all the markets the same way, so I'm not against doing a back test on currencies, commodities, and interest rates, and using those systems for the stocks as well. Don't even include stocks. Interesting. Yeah, exactly. Because, when you do that, and then let's include stocks, how are parameters changing? Probably not going to change very much. We have a fixed universe. Once we choose those stocks, in currencies, commodities, and interest rates, we don't want to change our universe. We don't want to change our unit size, our risk for each market. We don't want to. Maybe we will. There's stocks that go out of business, of course. I'm just giving bullet points because I'm having a hard time figuring out how to explain. But another thing, too, is, it reminds me of the study that Eric Crittenden did with, he told me about it, and he said he did a back test on all the stocks that were delisted. They no longer existed. They went out of business or they were bought, and they made about the same amount of money as the stocks that were still around. So it's really hard to. Now I pay attention to the trade stats as well. So I don't put a lot of emphasis on what the equity curve looked like over the past 20 or 30 years for a hypothetical system, as much as what is my average trade, my average win, my average loss, win percentage. So testing all the stocks, or as many stocks as you can, and getting a good indication as to what parameters may work. We've certainly, over the years, we would do back testing with stocks and the futures markets, and we would realize that we have to be careful because the stocks were so profitable, they would start determining the parameters if we let it, So it's once again, I think it's perfectly fine to just choose your parameters based upon currencies, commodities, and interest rates. Do that back test and then use those same parameters for the stocks. I don't think it's going to be much different.
And isn't the other secret also that you actually, the way you pick your universe of stocks, it's not really rocket science. I mean, you take the big names in a number of different sectors. You're not trying to necessarily screen for, all sorts of detailed things when you look at the universe of stocks, or am I wrong on that one?
No, I screen for the number of the average volume, and then once I can run these screens, and my average volume would produce about 260 stocks, some non-U.S. stocks that are traded in the U.S. So then I just start with that list. I start looking at the correlations. So I don't think putting together a portfolio has anything to do with historical performance, which stocks performed well. So CTAs I am kind of strange in that the rest of the world is trying to find the best stocks to own. I said many times, I want to be short some stocks or flat stocks in a big bull market. Thus, I know I have a good portfolio. It's met my criteria of as much diversification as possible. So, I don't know, am I getting close to making sense?
No, I mean, I think that's right. I mean, I think what the question suggested to me, at least, was that there was a lot more screening, filters, market cap, that things that do change over time. But if you're screening based on, say, volume, I mean, then obviously that maybe is a little bit more simple, because what you're looking for is liquid stocks, and therefore they it doesn't really matter so much with some of the other things, because you want a liquid instrument, just like the futures that you have in the other sectors.
Stocks have particular problems with, cocoa has been around, or coffee's been around a long time, and it's always been tradable, and stocks are just not that way. There's new stocks, and there's stocks that are no longer tradable. It's more of I forgot the term, but it's a harder to get a proper universe and do the proper back testing, for sure.
Yeah. Have you ever dabbled in single stocks, Moritz, or are you?
Yes, looking at it.
Yeah.
And there's a couple of things to it. Also, the corporate actions, dividends, stock splits, all of that, I think need to be incorporated. I like the idea of trading single stocks. I can completely understand where that makes sense. It does provide an extra source of diversification compared to the indices. It does come, I guess, at a small cost of liquidity, even though I'm not sure if that's really measurable in the way that you can trade them now with the single stock futures, trading on the close, all of that. So I've mentioned that before. It's one of the things that I'm looking at right now as we speak, and I find it just logical to trade them.
Yeah, I think it's like this, just be on the lookout for new stuff. I can't wait to, I would get excited when natural gas became a market, or when I could add the rupee, or emissions was a new market. So I'm getting excited about Beyond Meat. What's the difference? It's something new and different. It's going to add diversification. Exactly. Recently, we had sort of the opposite problem, and I'll tell you how we went about it. Is we decided to do a project to say, okay, let's find 35 stocks that are different. They're not correlated. They're low correlation, and we're trading those stocks now. And I looked the other day, and 40% of those, the S&P hit a new high on Friday, I'm flat and short 40% of my universe. What are you doing? You should be fully long the S&P. You're blowing it. Well, in the same way that none of us really enjoyed being short all the currencies, a few months ago, or we're always short these commodities, no longs out there, hey, it's the same way. I like to make a lot of money. I like to be long the S&P. I like it when all the stocks go up. 2013, we had a monster year because we were long 95% of our stocks into 2013. Now we're only long 60%. But recently we had the opposite problem where we did the back test. We chose this group of stocks, lots of liquidity, lots of differences. Tesla, Canopy Growth, marijuana, just trying to find exotic. And the numbers were coming back and choosing these stocks because they were different. And then we did the back test, and this group made a lot less money. Well, we can't trade this group. Yes, we can, because we're not supposed to we're not supposed to choose our universe based upon how they did profit-wise, just their contribution to diversification. So we did the back test. We had worse results, full speed ahead.
Yeah, did you see the article on CNBC's homepage on the 29th of June? It's headed 80% of stock market is now on autopilot. And then they go on to say that 60% of the equity assets now are, based on quantitative funds relying on, passive investment approach. And now you have these trend following models instead of fundamental research now account for 20% of the market share. At least that's what they think.
Yeah, I think trend following in cash stocks is rampant. At one point, it was all that was there. Back in the day, cash equities, that's where everyone got started. What else was there? Following these trends. And I think for probably a lot of people who listen to our podcast, stocks are where it's at for them. They have their Schwab or Fidelity account. There's no leverage. They can't get in trouble. It's long only. It's can't borrow money. Well, you can, but and so it's an easy way to get going and understand and watch the markets. The trends have been good. It is just perfect to get to test out your ideas and to get some initial trend following under your belt. And then when I think people, hopefully when they see the benefits and they experience the benefits of trading their stocks with the trend, they'll see benefits of adding currencies, commodities, and interest rates and allocating to CTAs.
Absolutely. Let me quickly, so those were the questions, by the way. So thanks so much. And if you have, if any of you have questions for us for next week, just send them to info@toptradersunplugged.com and we will happily dive into those. Let me just quickly run through where we stand as of Thursday evening in the indices. And if you want to think of any other things you want to bring up before we bring this to a close. So as I said, this is at the end of Thursday. I believe Friday was a down day. That's my guess. So just be aware of that. The B Top 50 index was still up 72 basis points for the month of July, up 606 for the year. SocGen CT index up 73 basis points, up 5.48 for the year. The SocGen trend following index up 92 basis points, up 8.42 for the year. SocGen short-term traders index pretty much flat, slightly down, up 13 basis points or 0.13% for the year. And the Bridge Alternatives index up 0.5% for the month of July, up 5.91% for the year. Any closing thoughts, ideas, topics?
No, but looking forward to another interesting trend following week, whatever the outcome may be. But happy trading. It'll be fun.
Yes, I appreciate all of the feedback and the positive feedback that we get, and just caution people to take some of it with a grain of salt. And just no one's perfect in this field, but it is a lot of fun on Twitter and on these podcasts, getting to know people, and these questions are really fun to answer.
Absolutely. We're grateful for all of that. So if you want to give something back to us, completely free, of course, then or it's up to you, of course, then do share this podcast with a like-minded friend or two. That would be very helpful. Otherwise, just want to finish up by saying thanks so much for listening. And we look forward to being back with you on the next edition of the Systematic Investor. And in the meantime, have an awesome week.
Thanks for listening to the Systematic Investor podcast series. If you enjoy this series, go on over to iTunes and leave an honest rating and review. And be sure to listen to all the other episodes from Top Traders Unplugged. If you have questions about systematic investing, send us an email with the word question in the subject line to info@toptradersunplugged.com, and we'll try to get it on the show. And remember, all the discussion that we have about investment performance is about the past, and past performance does not guarantee or even infer anything about future performance. Also understand that there's a significant risk of financial loss with all investment strategies, and you need to request and understand the specific risks from the investment manager about their products before you make investment decisions. Thanks for spending some of your valuable time with us, and we'll see you on the next episode of The Systematic Investor.